Hello guys, it's Toby here, the Ecom Business Coach. In this training today, I'm going to teach you everything you need to know and understand as an Ecom business owner to be able to analyze your paid per click marketing. That's your Google ads and your Facebook and Instagram marketing. This is obviously a crucial area for your business, and by you understanding some of the key numbers that you need to look at and to monitor, you'll be able to tell whether you're making a profit or not of those campaigns without needing to rely on the consultant or the agency telling you whether you are or you're not. This is a tricky area for ecom business owners, and I find it time and time again where people don't really understand it. And these are some of the basic numbers that you do need to understand that will help you make better decisions as to whether you should invest more money, change the campaign, or stop the campaign, or what it is you need to do to make sure you're making a profit on your ads and you're driving your ecom business forward. I was just working with a client last week and we were reviewing their campaigns as we do on a regular basis and looking to see where they were making money and where they were not and what we need to do to improve the situation. Now with these guys, we'd recently just changed ad agency. And we actually got two different people one doing Google ads and one doing the social media marketing. So we were then looking at their reports to see how well those campaigns were running. Now, one of the key things is we found by understanding the numbers of the business, so we sat down and calculated these numbers we're going to go through in a second, that you need to do in your business. But by them understanding their numbers, we were then able to drive our decisions about which campaigns to invest in and which ones not to based on those numbers. So for example, we could see certain campaigns weren't getting our return on ad spend that we wanted. So they were losing money. So we could stop spending money on those campaigns and spend money on other campaigns that were making a return. One of the other key things as well, especially on the most social media side, a lot of the time people will drive, or your agencies will tell you, or will focus on reach. So they go, we've reached this many people. Reach is great, but it still needs to turn into sales. It still needs to pay for itself. So for example, when we looked at the campaigns they were running, their top performing campaigns were all based on reach. Look how many we reached with this campaign. Look how many we reached with that one. But when we actually looked at how much that converted into sales and how much the return on ad spend was, it just wasn't there. They weren't the campaigns that were performing well. So while the agency thinks they're doing a great job, from our point of view, we're not getting our return on investment. So we're wasting the money unless that traffic can be driven through later on, which sometimes it can. It's not all about necessarily getting, especially on social media, getting the return straight away, but it has to come pretty damn quick. In reality, what I tend to expect is when I look at the ad campaigns or Google ads campaign, I expect their return on ad spend, for example, to be a bit higher than the social media campaign, because there's traffic on social media which isn't what we call warm traffic. And if you think about the difference, really, if somebody's on Google, quite often they're looking for your product already, where if they're on Facebook, they're not, or Instagram, they're not looking for your product. We're kind of interrupting them, although some Facebook traffic and Instagram traffic will be retargeting a warm audience already. But by us understanding our numbers, we were able to see exactly where we could save some money. And instantly, we transferred some money across from one campaign to another, where we could see that wasn't working. And then we could then refocus the ad agency to make sure they were going for the right type of ads from a social media point of view. Overall, that then helps us to increase our return on ad spend, which helps us to be more profitable. So you need to be doing the same thing. You need to be regularly reviewing your reports from your ad agencies or consultants that you're using to help you with this stuff. Now, as an ecom business owner, you can't be expected to be doing it. It is a very complex area, and it takes a specialist really to be able to do it. Even just keeping up with Google ads versus Facebook or Meta advertising, they change all the time. Tips and ways of doing it change all the time. You need to find an expert. What I found works best at the moment, it used to be kind of you go to an agency who did it all. Now I found it kind of works a bit better if we find somebody who specializes. So I found somebody who specializes in Google, they do my Google marketing. I found someone who specializes in Meta, they do my Meta marketing. So that is working better at the moment. But the key thing is you need to understand enough as the e-com business owner to be able to hold them accountable. Because if you don't, they will pull the wool over your eyes. They'll tell you things are happening that aren't. They'll tell you that you're making more money than you are. And if you don't know the numbers, you don't know the right questions to ask to find out if that is the case or not. And sometimes it's just a case of they're not looking at it strongly enough either. A lot of agencies and consultants, once they've set it up, set and forget. And they look at the overall reporting and go, yeah, everything's happy. But often they're not focused on the right numbers and not focused on the numbers that we're interested in. So let me drill in. And what I'm going to do is I'm going to go through these numbers and I'm going to explain what they are, the terminology is, where to get their figure from. You're going to learn a lot of numbers, I'm afraid. So please hold in there. I'm not going to teach you more numbers than you need to know as a business owner. Some of them you may know, so bear with me as I go through them and explain them. Some of them you may not, but stick in there. I know I'm an accountant and everybody thinks I just love numbers, but numbers are important. They are the language of business and they are the language of your your Google Ads and Meta campaigns. So they definitely are the language of whether that's working or not. But what I'm going to do, I'm just going to open up my ROI calculator, which I use to put numbers in to find out where people are making money or not on their paid traffic. So PPC, first of all, there's lots and lots of acronyms in digital marketing. So there's some of the stuff you need to get your head around straight away. So here, ROI is return on investment. PPC is paid per click campaigns. So often what will happen is when you're paying for traffic on your e-commerce store, you pay per click. So every time someone clicks on the ad, you pay a certain amount. You do pay for reach a little bit on social media as well, so it's not quite all paid per click, but that's the type of marketing we're talking about. And this area of marketing for e-commerce is vital to your success. This is where you invest to get traffic to your site. So it's really important you do it, and your e-com store will not be successful if you don't. So you do need to do this, and this will be the core of your strategies for getting new customers. So it's really important you get it right. Don't be shy to spend the money, but you need to make sure you're making profit. So they're the two first acronyms straight off the bat: return on investment and pay per click calculator. So the first figure that we need to calculate is your average dollar sale. So your average dollar sales just says, on average, how much is each transaction on your e-com store worth? Now, your software will often tell you these figures. So if you look at the analytics on your software, so if you're in Shopify, for example, that will tell you your average spend. So you can go and find that figure. And you want to find an average. And all that really is to say, okay, over a time period, let's say a year, we've got X amount of sales going through our e-com store. So the total sales was 100,000. How many orders was that? Divide the two next to each other. That will give you an average. Obviously, some transactions are higher, some are lower, but we want an average. We want to know what your average transaction value is. And obviously, that's something you need to work on to improve because that helps you grow. But let's work out what your average here transaction value is. So for this business here, their average transaction value was $55. So they managed to get $55 on average per sale. Now, that doesn't include shipping. How you calculate your shipping is different. Well, everybody does it slightly differently. Some people offer free shipping and basically factor it into the price. But if you're charging shipping on top, don't include the shipping in your average order value. Because if you're just kind of covering your shipping costs, it's not really part of you making money. Now, if you are not charging postage, then you need to take that out as a cost of sale, which is the next figure we're going to look at and need to learn about. The next thing is your gross profit margin, or gross profit percentage. Gross profit is the sales that are left after paying direct costs of your business. It's after you pay for your product. If you're reselling a product, you pay something from the supplier, plus any shipping you pay for the supplier to get it to you. That's your cost of sale. You minus that off your sales value to get your gross profit. And then you can divide that by your sales to turn that into a percentage. So you can work out what your percentage is, your gross profit percentage is, which is obviously, again, really important figure to know and really important figure, an area you can improve. That becomes a bit more complex when you're manufacturing the products yourself. So then you have to work out how much it costs you to manufacture the product. There's obviously labor behind that, some materials for how to build it. But this is why it's really important to know your numbers in your e-com business. So you do know your numbers around this. So this business here, you can see their average gross profit margin on each transaction is 60%. Now your average margin for a business as a whole is 30%. Now if you're an e-com store though, and you're manufacturing your own product, or you're selling products you've got the right to for your country, so no one else is selling them, then, and you're selling direct to end users, then I'd expect your margin to be a bit higher, 60 to 80%. And that's because obviously then you can do wholesale as well if you've got that margin there, and share that margin with them. So you get 30 or 40% each. That's what you need to be doing. This company has a 60% margin. Now, if you're reselling somebody else's product, depending where your product is, but you're going to be lower. You're going to be the 30, 40% margin instead. But it's really important you know what your margin is. That's the next figure you need to do. The next figure then is your cost per purchase. And this will come from your agency or the reports they send through to you. That's a key stat that you need to know. On average, how much does it cost you in ad spend before you get a sale? So sometimes it's cost per purchase, sometimes it's cost per transaction, or cost per conversion. They're the type of stats you're looking at. You want to know, okay, how much does it cost me to get a sale? So for example, this business here costs them $20. So every sale costs them $20. They get $55 in sales value, which after they take the costs out for that product, leaves them with 60% of that. So that's what that's saying. Then we've got the number of sales. So this is the next important thing. And this is talking about customer lifetime value. So we want to know, okay, some businesses have one-off sales. So they sell once and they never get the customer again. And then they have to work out how to then either find other products to sell to them. And you've got the other reserve where people buy products off you regularly. Now, obviously, if people buy products off you regularly, you're going to get more money for them, and your lifetime value of that customer is potentially going to be higher. So that means you're willing to spend a little bit more to get the customer. If you're dealing with one-off purchases, then you have to be careful that you're not spending too much to get that purchase, that you're not making any money. And it's again why it's really important you know your numbers. So you're going to need to know on average how many times a customer deals with you over their lifetime. So you can do that by kind of looking at the number of sales versus the number of customers. The number of actual sales invoices raised or transactions through divided by your customers will give you on average how many each time, how much each customer is buying from you, how many times. So for this business here, it's 10. So they get repeat sales of about 10 on average. But some customers might come in and buy it once and not like the product. Some may be buying it for 5 years. But what we're saying here is on average, people buy it 10 times. And then the other figure we've got here is your return on ad spend. And again, this is a figure you'll get from the reports. And if your agency or contractor is not giving you that information, make sure you ask for it. And make sure you check it for reasonableness as well. I've had clients where they've set it up so badly that it's double counting, for example. So you have to, and you can kind of check it for reasonableness if you look at your own analytics in your store. So for example, if you're in Shopify, it will tell you where the sales are coming from. It will give you an idea. So if those two kind of match, then you might be all right. But you want to find out what your current return on ad spend is. The return on ad spend is just how much you get back for every dollar you spend on advertising, how much you're getting back in sales. So these guys here, every dollar they spend, they get $3.50 back in sales. So they're the key raw data and information you need to start looking at the numbers in your campaign. Now let's look at some of these results and what that looks like. So here we need to look at your PPC KPIs, paid per click, key performance indicators. The KPIs is just what the key performance indicators we need to look at to know if something's performing or not. So the first one then is your return on ad spend break even. So how much does your return on ad spend need to be for you to be at a zero position. This is the lowest you want to be before you start losing money. So here that's 1.67 times. So you can see here at the moment, our return on ad spend is 3.5. So that's well above their break even. So that's good. It means it's in a profitable situation. We're happy with that. Then we're going to look at your profit on loss on the first sale. So the important thing to note here is a lot of businesses will be prepared to lose money on those first few sales because they know, here for example, we get 10 sales. So they might not be in a profitable position until they get to the second, third or fourth sale. But they know that they're going to be able to get to that position at that point. So they're willing to spend that much more. But it's really important if you're in that situation that you know your numbers and that you know that kind of, for example, the average number of sales you get from each customer is right. So it's, again, it's really important to know your numbers because it will bankrupt you if you don't. Because if you are in that situation, then obviously there's a gap. There's a gap between what you're paying out in marketing until you get the profit back. So that's part of the cash gap. And I've just been training on the cash gap as a whole, but this is the advertising cash gap that might be there. So you have to be very careful of that. And that's often why some startups need funding and they go and get funding to fund that cash gap because they know and they've proved the figures that, look, this will grow, but I've got a gap, I've got to fund it. So that's often where they'll get that funding to fund that gap. But here you can see the profit and loss on the first sale for these guys is they're making $13 off the first sale. So that really is what the figure you're looking at there is the $55 times the 60% minus the $20. Because 60% is what's left from a profit point of view. Then you've got your minus your cost of purchase. That's the $13. So it's really important you get your cost of sales right and your gross profit right here too. Now, if there's some labour involved, it's really important you include that labour, for example. Now, and that's especially relevant if you're manufacturing. But you do have pick and pack as well, which is a cost per order, but often we treat that as a fixed cost. But bear that in mind as well. But here they're making a profit on their first sale of $13, which is pretty good. They're off the mark straight away. There's not a gap. They're not making it on the second or third or fourth sale. They're making it straight away. And part of the reasons for that is the cost of purchase is $20. Still quite reasonable. If that goes up, then obviously that's going to change. We'll mess around with the figures in a second. I'll show you what that looks like. Now, the other thing that's calculated here is your customer lifetime value. So that's just simply to say, okay, on average, you spend $55 per transaction. On average, we're getting 10 transactions per customer. So that means that we're making $550 off that customer in revenue. And in profit, so gross profit, we're making $330. That customer has cost us $20. So we know we're making $310 on that customer over the lifetime. So we know we're making money over the lifetime after paying the acquisition cost for that customer. And that's what, another word you'll hear, cost per purchase, is customer acquisition cost. That's a customer acquisition cost. So you always want to be working on lowering your customer acquisition cost and increasing your customer lifetime value. If you do those two things, you're going to be on a winner. You're going to get more profit. But it's really important that you do focus on that. Okay, so profits after paying acquisition cost is 310. So the number of sales in this scenario that they need to do to break even is less than 1, 0.61. So we know that's less than 1, and we know that because we're making a profit on that first sale. So we're happy with that. Now you can see profit per $100 ad spend for this example is at $110. That's profit. That's profit after taking off the ad costs as well. Now their return on ad spend, that means, is 110%. They're doubling their sales based on these figures. So that then will give you the confidence to turn it up, to invest more money if you're satisfied that these figures are correct. And that's the really important thing, and that's something you need to be very careful of, and making sure that you've got all the costs in there and you're calculating these figures correctly. Because you're making a decision here on whether to put your foot down and invest more money. Now, what would happen if the actual cost here was a lot higher? So say our cost per purchase wasn't $20, but it was $50, which isn't unheard of either. Delete that. Right. Cool. So at $50, let me get rid of that. You can see now they're actually making a loss on that first sale of $17. So even after the first sale, they're still in a loss situation. Now, if we go down, now it says the number of sales to break even is 1.52. So they're making profit on the second sale. So obviously in that scenario, it's very important we're focusing on getting that second sale as often as we possibly can. So you'll need funnels set up. So when somebody does that first order, that we do everything and do the follow-up, automate the follow-up with an email sequence to get that second order, for example. That's part of what we need to do. But you can see what happens there. And obviously, as that cost per purchase goes up, then obviously, then the how often or how quickly you make a profit goes up as well. Obviously, if you mess around with the margins or mess around with any of these figures, it's going to make a difference. Now, if you do want a copy of this calculator, I'll put a link below this video so you can go and grab a copy. Obviously, you can see how important this is to get it right. If you've got any questions about it, then please write comments below. If you want some help, I'll put a link in the description below so you can book in a call with me as well, and I can look at those numbers with you. I hope you found that useful. If you did, make sure you subscribe to the channel so you can get some more useful content. But this is a really important subject, so make sure you go away and calculate your numbers. Cheers, guys. See you next time.